Meet Susie. In 2012, Susie's parents enrolled her in soccer and other programs to keep her physically active. Thanks to the Government of Canada's Children's Fitness Tax Credit, Susie's parents can save on their taxes, and that'll help with the cost of keeping Susie active. So how does it work? Susie's parents can receive a tax credit of up to $75 by claiming the cost of eligible children's fitness programs. In order to receive the full $75 credit, they will need to have spent $500 or more. This includes registration and membership costs for Susie's programs, but not equipment or other costs. Susie's age matters too. To qualify, Susie must have been under 16 at the beginning of the year. Susie's 10, so she definitely qualifies. A non-refundable tax credit reduces the federal income tax that Susie's parents have to pay. However, if the total of their non-refundable tax credits is more than their federal income tax payable, Susie's parents won't receive a refund for the difference. Meet Ella, Susie's big sister. Susie's parents can receive an additional tax credit of up to $75 for the cost of Ella's programs too. And since Ella is eligible for the disability tax credit, they can receive a further $75 tax credit if they paid at least $100 for these programs. Since Ella is eligible for the disability tax credit, Susie's parents can claim the cost of her activities as long as she was under 18 years of age at the beginning of 2012. So how do they save this tax money? For 2012, their credit is 15%, the lowest personal income tax rate, multiplied by the amount they claim. We'll spare Susie's parents the math. If they claim the full amount for Susie, the credit is $75. And if they claim the full $1,000 for Ella, they save up to another $150. Enough of a savings to help with next year's costs. Susie's parents are really happy they can save on their taxes. But which of Susie and Ella's activities are eligible? Well, the programs have to be daily programs that last at least 5 consecutive days, like camps, or occur at least 8 weeks, like swimming lessons. The programs must be supervised, but this doesn't have to be a coach or an instructor. Some examples include certain camps, basketball, soccer, swimming or golf lessons, horseback riding, after-school programs, and even bowling. Examples of activities that don't qualify are activities that involve riding a motorized vehicle, like go-karts, and regular school programs like gym or sports academic programs like specialized hockey schools. And last but not least, the program must include a significant amount of physical activity. So Susie's chess club doesn't qualify, but her soccer camp does. As Ella is eligible for the disability tax credit, she must be involved in a program involving physical movement in a recreational context. Susie and Ella's parents won't have to send in receipts with their taxes, but should keep them in case the Canada Revenue Agency asks to see them. Then, when they're filing their 2012 tax returns, one of Susie's parents can simply enter the claim for the amount paid for qualifying programs on line 365. They can also split the claim and each enter an amount, but the combined total claimed must not exceed the maximum for both children. This amount will be applied to Susie's parents' federal taxes, and they may end up paying less tax. And next year they can spend a little more on that great archery camp the girls want to go to. Want to be like Susie's and Ella's parents? Here's a link for more specific information on what kinds of physical activity programs are eligible and how to claim the Children's Fitness Tax Credit.